Hey, what is going on, guys? My name is Nick, and in this video I'm going to be talking about 3 undervalued Canadian stocks that I'm looking to buy in 2020. Now, as Canadian investors at the moment, we're really dealing with a dilemma of choosing between Canadian companies and US companies to invest in. Now, on the one side of the coin, Canadian investors might be choosing to invest in Canadian companies over US companies for a few reasons. First of all, it is very well known that Canada offers some of the best dividend-paying companies in the world, and right now, with the stock prices much lower than before, we're seeing some pretty high dividend yields. Furthermore, as a Canadian investing in Canadian-based companies, you won't have to worry about the exchange rate to US dollars, which is at historically high levels at the moment. But by the same token, we generally all know that US companies have a lot higher growth than Canadian companies in general, which makes it a really tough decision for any Canadian to make if they are investing in both countries. But at the moment, I am focused more so on investing in Canadian-based companies, and that's why I've brought you this list today. So if you do enjoy this video, make sure to smash that like button for the YouTube algorithm. A ton of research went into this video, so I would appreciate that. Also, if you haven't already, definitely consider subscribing for more weekly investing videos just like this. And so with that said, let's get right into the 3 Canadian stocks that I feel are undervalued at the moment. Alrighty guys, now getting into the first stock here, so many people have been asking me about this one and what my thoughts are, so here you go. The first one is RioCan with ticker symbol REI-UN.TO. Now this stock was also partly inspired by Griffin Milk's recent RioCan video, so if you haven't checked out his channel, definitely give him some love. Now RioCan is one of Canada's largest real estate investment trusts, otherwise known as a REIT, and they generate rental income from high value properties for their unit holders. Now RioCan is a very narrow focus on the 6 major markets over here in Canada, where over 90% of their revenues are generated. And they actually have the majority of their properties focused in the Greater Toronto area, which is a high growth area, and that represents over 50% of their revenues. And this is, of course, one of the reasons why this REIT in particular is able to grow its net rental income at a very high rate compared to some other REITs. But as we can see, over the past few months, RioCan's unit prices dropped off a cliff, sitting about 50% off its all-time highs from early 2020. And that is because they do have a very high retail exposure in terms of their commercial properties, which is of course taking a very bad hit right now with the economy being shut down. And this does actually bring their valuation all the way down to a price to book ratio of 0.58 right now, which is insanely cheap on a book value basis. However, it is possible that the company's stock price is too oversold at the moment because many of its commercial tenants are in essential businesses. Those would include businesses like Safeway, Walmart, Costco, Home Depot, Canadian Tire, many of the Canadian banks, and the list goes on. But let's first take a look at the company's recent financial statement that they put out for Q1 of 2020. Alright guys, now the first thing I want to point out about RioCan's earnings is the funds from operations in the past quarter, which is essentially the earnings per share for a REIT. And as we can see in the most recent quarter, they produced FFO of 46 cents per unit, while in 2019 in the same quarter, it was 47 cents per unit, so it really hasn't changed. And taking a look at their net income, after adjusting for many of the capital gains that they received on property sales, we find that their net income actually rose year over year. In the most recent quarter of 2020, they had adjusted net income of 137 million compared to 2019 net income of 134 million. So up to this point, it really doesn't appear that the whole market issues have impacted RioCan in too bad of a negative way. But we will likely be seeing the ramifications in the next quarterly update after businesses have been impacted more so by the shutdown. Now at this point in the video, I want to get into the distributions that RioCan pays because this is the major reason why people invest in REITs. So as we can see, RioCan paid out their distributions as normal for the quarter, being 36 cents per unit, which is the same thing in 2019. Now that might look all fine and dandy that the company's continuing to pay that distribution, but if you take a look at the stock price chart, we can find that their dividend yield is sitting just under 10%. And like I've said many times in the past, guys, if you see a yield above 7 or 8%, it's generally a sign that the company is going to be cutting that dividend. But at this point in time, I really don't see RioCan cutting that distribution because their payout ratio for the past quarter was still sitting at about 77%, which was actually lower than the previous quarter in 2019. And guys, in terms of a payout ratio, this might seem a little bit high, but in terms of their FFO, their funds from operations, this payout ratio is quite normal and actually quite conservative for a REIT. We can also take a look at the REIT's distribution history, and over the past 15 years, we have not noted any cuts in their distributions, and they've actually been increasing it for many years consecutively. In fact, even if we go back to the 2008 financial crisis when their stock price dropped 50% in 2 years, the distributions actually remained constant throughout that entire period, and the company was actually increasing them throughout 2007 and 2008. So in terms of the distribution history, this REIT has proven that it can maintain its payout ratios during really tough times and continue paying out those dividends to unit holders. But of course I could be wrong, and it seems that the company is priced for a distribution cut where it's at right now, so keep in mind that the risk still exists that it could be cut. And really that will all come down to the amount of earnings and the liquidity that the company will have in the next quarter, and so let's get into their balance sheet. So in the latest quarterly update, we can find that the company does have liquidity of just about $1 billion right now, while the amount of debt that is maturing throughout the remainder of 2020 is only $770 million. So from this alone, we can easily see that the company will be able to meet all of its debt obligations even if it doesn't make net income. And if we realize that their distribution generally costs about $112 million per quarter, this signifies that they'll probably be able to keep their distribution throughout the remainder of 2020 even if they only make a little bit of net income. And if we also consider the fact that the company's already received 55% of the rents for April, along with another expected 28% to be received, I think they're in a pretty good condition for now. Alrighty, now the second undervalued Canadian stock that I have on my list today is one that I own in my personal portfolio, and that is Scotiabank with ticker symbol BNS.TO. So as many of you would know, Scotiabank is one of Canada's big 5 banks, and they are 188 years old. In terms of their portfolio, the bank operates primarily in Canada, where about 49% of its revenues are generated. But they do operate in Latin America and several countries around there like Peru, which has very high growth opportunities as opposed to many other areas in Canada. And guys, I don't want to bore you with the details about this bank. Many of the top 5 banks are very similar and are very well diversified, so keep that in mind. But now let's take a look at their stock price performance over the past few years. So currently the stock is trading over 36% off its all-time high from late 2017 and over 30% off its recent highs in 2019. And because Bank of Nova Scotia does have a little bit higher exposure to oil and gas, just like BMO, it has sent its stock price down a lot more than some of the other Canadian banks. And with all of this downward pressure on the stock recently, we are able to buy this company at a price to book ratio of 1, meaning you're able to buy this company at its net asset value. And based on history, this could be showing that the bank is showing some pretty good value at the moment. So guys, taking a look at some of their financial metrics, we can find out if this bank is really in a good position right now or not. And the first thing I like to look at is the cash and deposits with other financial institutions, and right now that is sitting at $46.7 billion at the end of 2019. So in terms of the company's overall market capitalization, we find that the amount of cash that they have and those deposits in other financial institutions is very high at the moment. And if we compare this to the amount of dividends that they paid in 2019, which is a very high yield, generally above 5%, we can find that they paid out $4.4 billion in dividends while they have over $46 billion in cash and deposits, so that's a really good sign. And in terms of the dividend, this is one of those companies that was able to hold this dividend constant throughout the financial crisis, which is a very good accomplishment for banks. And then they do boast on their website too that they have been paying a dividend continuously since 1833, which is absolutely insane. And if you were to buy into this company at the lows at the moment, you would be getting a dividend yield of 6.8% for the forward year of 2020. So guys, the way I see it is that if I'm buying into this company right now, I'm getting paid to wait on this company for future capital appreciation because the dividend is going to continuously pay me that 6.8%. And what makes me so confident about this dividend staying constant throughout this entire period is what the CEO had to say back in April. The CEO of Scotiabank, Brian Porter, says that they expect somewhat elevated loan losses over the next 3 to 4 quarters due to businesses not being able to meet loan commitments. However, he also says that the bank is certainly committed to paying their dividend. And with the bank having 3 times as much CET1 capital, being 11.1% right now, as it did during the financial crisis, it is very well prepared to weather the storm hitting the worldwide banking industry. So guys, based on the CEO's comments here, I have very few worries that the company won't be able to meet its dividend commitment, and that means you're getting paid to wait just for holding the stock right now. But guys, of course there is still that risk that they could cut the dividend if the loan losses come in higher than expected, and so let me know if you want me to make a video on that once the banks report their earnings. Alrighty guys, now getting into the third and last undervalued Canadian stock on the list here, this one is a little bit more risk oriented but does have that higher reward potential, and that is Air Canada with ticker symbol AC.TO. Now, as many of you know, I spoke about this stock in my top 3 stocks for 2020 video, which I'll link to above here. But I do just want to give you guys an update based on their earnings report that came out on May 4th to see if this stock is still undervalued and still a buy. But first, just to give you some background, Air Canada is the largest provider of scheduled passenger flights within Canada and for connections between Canada and the US, along with Canada and the rest of the world. But obviously, the aviation industry has been hit extremely hard, and despite Air Canada having one of the best balance sheets in the industry, they're still down over 60% from their all-time highs in 2020. And as a result, that actually brings the company's valuation all the way down to a price-to-book ratio of 1, meaning they're trading at their net asset value. So based on this alone, the company might be presenting a pretty good risk-reward opportunity, but we first have to look at their updated financials to see how the company's doing. Alrighty guys, so jumping straight into Air Canada's income statement for the quarter, we do find that they had total revenues of $3.7 billion, while they had total operational expenses of $4.2 billion. So on an operational basis, the company actually lost $433 million, but as we can see, they also had non-operational expenses, and as a result of foreign exchange, they actually lost $711 million because they do have some operations and assets in the US. And that actually resulted in a net loss of $1.05 billion for the quarter, or $4 per share. So guys, the company is obviously struggling in a major way to produce any profits, and it's likely that they're not going to be profitable for the remainder of the year. So what that tells me as an investor is that I need to start looking at the company's balance sheet to figure out how long they're going to be able to last in this current state. So in their latest quarter, we do find that Air Canada had cash and cash equivalents of $6.1 billion at the end of March, while their current assets were at $7.3 billion. So first off, it's good to see that a lot of their current assets are sitting in cash right now, and that means they'll have more liquidity to be able to deal with any issues. And then taking a look at the other end, we do find that their current liabilities are sitting at $6.4 billion right now. So it's good to see that their current ratio is improving. It's above 1 right now as compared to their last quarter, which was slightly below 1. However, their cash still won't be able to cover all of these current liabilities. But what I haven't told you yet is that the company gave some recent liquidity updates for April of 2020, which wasn't included in the previous quarter. So in April of 2020, the company was able to obtain a secured loan backed by several of its assets, like its planes and engines, for $829 million. Therefore, if we add up this $829 million that they did receive in terms of that loan to the amount of cash that they had on their balance sheet at the end of March of 2019, this does give them around $7 billion in total cash. However, if the company keeps posting $1 billion losses for the remaining quarters of 2020, they will run out of cash by the third quarter of 2020, and that means they're going to need to seek additional financing or aid from the government. So we have to ask ourselves, is it likely that the company will be burning through $1 billion every quarter for the remainder of 2020? And based on the future estimates, analysts are predicting worse numbers in the next quarter, which does make sense because the company was at least somewhat operational in the months of January and February, but then March, April, May, June, July is obviously going to be a total write-off. So based on all of this, do I think that Air Canada is going to go bankrupt? Well, no, I don't, and here's why. It all comes down to the fact that Air Canada is the largest airliner in Canada and is a staple to the Canadian economy. The company employed over 30,000 employees before this whole thing happened, and that is a big chunk of the economy. And what we do find is that they plan on rehiring 16,500 employees that they recently laid off a few months ago due to Canada's emergency wage subsidy. So that means they're not going to have as many expenses when it comes to employee wages. But in terms of going bankrupt, I really don't believe they will, because the company recently stated that they still have tons of unencumbered assets that they can utilize to obtain more loans. And as we all know, this company is aggressively searching for more liquidity at the moment, and I think they will be able to obtain it. However, if it did come to the point where they needed additional government support, I think the government would give them a bailout, but it wouldn't come without strings attached. So at the moment, I do believe that this company does present some pretty high risk, but I think that the reward is very, very substantial over the next 3 to 5 years. And with that being said, thank you guys so much for watching the video. If you did enjoy, make sure to smash that like button to support my channel, and let me know down below which of these companies you like and which ones you might be buying. But as always guys, make sure to do your own research, because there's no way that I could include all pertaining information to these companies in a short 10 to 15 minute video. Anyways, if you haven't already, definitely consider subscribing down below for more weekly investing content just like this, and I will see you guys in the next one.